In this week's video, we'll review the latest charts to help us answer the question, stocks, beginning of the end or the end of the beginning? We've got a lot to cover, thus we'll be moving quickly. Feel free to use the pause button on your video player. Some of the categories we'll be covering this week, but we'll kick it off with the age-old question whenever markets are strong: blow off top or early stage thrust. This is a monthly chart of NASDAQ advanced decline volume. This is the indicator here. We basically take advancing volume and subtract declining volume. This chart is dated month end November, so November 30th, 2020. Here's the indicator here. This is market breadth. We closed above this upper Bollinger Band for 8 consecutive months. The blue line is the upper Bollinger Band. This is the breadth indicator here, and this is the center line on the Bollinger Band. This is a relatively rare look. The question is, how rare is it, and how did the stock market perform in the historical cases? The answer to how rare is it is extremely rare. NASDAQ inception 1978. We've only seen 2 similar cases: April 30th, 1983 and September 30th, 1995. Before we fill in the table for S&P 500 performance, let's ask and answer. How did the stock market perform from a longer-term perspective walking forward from those 2 dates? In both cases, really good things happened for a long period of time. In the 1983 case, the additional gain between April 1983 and the spring of 2000, the end of the secular trend in the S&P 500, was 829%. In the second case, from point A, date of the signal in 1995, to the spring of 2000, the S&P 500 gained an additional 161%. And on a shorter term time frame, in both cases, the stock market was higher 2 years later, 3 years later, 4 years later, and 5 years later. And the left side of the table reminds us that it's possible that we may be entering the Nordique phase of this bull market. What is the Nordique phase, you might ask? Here's the date of the signal here in 1983. You can see any gains right off the bat in this case were fully retraced. In fact, the stock market was lower 2 years later. This is basically the market digesting its gains off of the secular low in 1982. Why do we refer to it as the Nordique phase? Because this phase of the market can look like the logo of the Quebec Nordiques. You're down here now. This is similar to point A. It's very, very possible at this stage of the rally, even if we push higher, that much of those gains, if not all of them, will be given back. We can see that on the chart, and we can see that on the table. But notice we said we may be entering the Nordique phase of the bull market. Typically after the Nordique phase comes the Hartford Whaler phase, blue and green. If we can withstand 100% normal and to be expected volatility, at least in these historical cases, the longer-term reward was very, very satisfying. Average gain 2 years out, 36%, 3 years out, 63%, 4 years out, 95%, 5 years out, 104%, worst case scenario from the date of the signal, 60% higher 5 years later. We'll be talking about the Nordique phase in a little bit more detail later in the video. On the left side of the screen, the NASDAQ Composite Tape Index. This is the long-term version of that index. There's a little blurb about the index here. You can find more information on stockcharts.com. This is basically a composite breadth indicator. Think the number or percentage of stocks participating in a rally. If you know your market history, you know the S&P 500 peaked in October of 2007, and then really, really bad things happened in 2008 during the financial crisis. Here's the peak in the S&P 500 here you can see there's some weakness in the breadth indicator before the S&P 500 peaks. Similar situation here in 2011. We really can't even see the upper Bollinger Band here, kind of moving sideways as breadth deteriorates. 2011, you may remember the market had a reversal on October 4th and then pushed higher. This is a concerning look. This is a concerning look. Similar situation in 2015. This is the early stages of this rally. This is the latter stages of this rally. Once again, the upper Bollinger Band off of the chart here. This is somewhat of a waning momentum look here. And then really, really bad things happen in August. These aren't necessarily predictive tools. They're more slightly predictive to coincident. When the market starts to fall, this type of indicator helps us understand how bad it might be, and more importantly, how bad it is from a breadth perspective. Therefore, it might be helpful to ask and answer. This is a deteriorating look. This is a deteriorating look. And this is a concerning look. Does 2020 look better, worse, or about the same? The answer is much, much better. See how the upper Bollinger Band is still on the screen here? We can't even see it here. Can't see it here. And if we zoomed in here, you can see we're starting to drift away. Moral of the story here is on December 1st, 2020, market breadth for the NASDAQ composite looked a lot better than it did in these three concerning examples. And we all know it's very, very possible that this chart could change very, very soon in a concerning manner, but it hasn't changed yet. Similar theme here, sticking with market breadth. NYSE advanced decline volume monthly. Once again, we've got a Bollinger Band here. You can see we come down, we get a close outside the lower Bollinger Band in 2009. Similar situation here in early 2016. Get a couple closes below the lower Bollinger Band and eventually bounce back. You can draw a trend line attaching those two lows. We recently broke below it, and now we have a close at month end on November 30th. This is a monthly chart, back above that trend line. In all three instances, we get a close below the lower Bollinger Band. Then we get multiple closes above the lower Bollinger Band. And in each case, eventually we close back above the center line. All of that is true in 2020. In the two previous cases, good things happened and good things happened in the stock market. There's a major low that occurs in March of 2009 in the S&P 500. And if you know your history, you know the S&P 500 bottomed in early February of 2016, well before the election in November of 2016. This chart, like every chart, can't predict the future. It simply helps us assess the probability of good things happening relative to the probability of bad things happening. If we examine hard data to help us better understand investor behavior, are we seeing continued signs of animal spirits? Or does it look like some market participants are starting to look for the exits in the room? Before we talk about this chart, it should be noted, when we show a chart in these videos, we're not necessarily saying the Nikkei is the best place to put your money. In fact, if we looked at a relative chart of the Nikkei divided by the S&P 500, you would see why this index still has a lot of work to do. However, this could be a good start. The longer a market goes sideways, the bigger the move that you can expect to get after you get a bullish breakout or bearish breakdown. It's been approximately 35 weeks since the S&P 500 bottomed in March of 2020. The lower panel shows you the 35-week rate of change for the World Basic Materials Index. This is an index of stocks related to basic materials. We have data going back to 1999. We're looking at all of it. Only 3 times has the 35-week rate of change gone up and hit this blue line. calendar year 2004, 2009, and you guessed it, 2020. You can also make an argument this setup here could be similar to this bullish breakout here. Once again, the longer we stay above the dotted line, the more relevant it becomes. Were these good times to invest? Yes. The first low, major low, came after the dot-com bust in October of 2002. We know we have the major low in March of 2009. And right now, it looks like we have a major low in March of 2020. Clients and regular viewers may remember we looked at charts like this down here near the low, and we said this type of look here is telling us it's possible that we're seeing the early stages of a relatively rare breadth thrust. We have data going back to 2002. The breadth indicator in this panel here shows you the percentage of S&P 500 stocks above their 200-day simple moving average. Very, very rare. Only 3 times have we been this oversold, this blue line here, and then made it all the way back to the upper blue line. And in each case, it happened very, very quickly. And in the 2 previous cases, it happened after a major low in the S&P 500 index. This aligns with animal spirits. If you're a sector person, you know that banks in the U.S. have been big laggards. That's true for the most part all over the world. This is the World Financials Index composed of stocks. It's a monthly chart going back to 2002. This is monthly MACD that helps us with long-term momentum. This is a bullish cross that we are trying to nail down in the month of December. That's why it says in the upper left-hand corner of your screen, not nailed down yet. But if it is nailed down, it looks a lot like this in 2003, this in 2009, this kind of head fake look here, but eventually we get the cross, 2012, 2016 near the U.S. election. Here's another head fake look, and we get a second attempt here. But for the most part, you can see that this speaks to bullish probabilities, 03, 09, 12, 16, and possibly 20. From a historical perspective, those were excellent risk-reward entry points. 2020 case, to be determined. There are a lot of important nuances on this chart, so I apologize if we can't do it justice in the time we have allotted, but we'll give it a shot. This is bonds divided by stocks. So this helps us understand whether we want to own bonds relative to stocks. This is when we want to own bonds. This is when we want to own stocks. If you're familiar with ETFs, this is a lot like AGG, a diversified basket of bonds, divided by SPY, or the S&P 500. This is a daily chart dated December 2nd. It had been 176 trading days since the low in 2020. Once again, very, very rare for the 176 trading day rate of change to get down this low. It's only done it 3 previous times. 1999, the bull market was not over. Still had some juice left in it. And after the major low in 2009, the only other time, basically where we are today, December of 2020. So some of you may see 1999 and say, hey, we are near the end. That may or may not be the case, but there are some differences on this chart here. This is 1999 here. The S&P 500 peaks on March 24th of 2000. This is what we want to own stocks looks like, and as you might imagine, in the spring of 2000, it starts to flip, and this is what we want to own bonds looks like. Secular bear, in this case, refers to the stock market. After this peak in 2000 all the way out to 2013, the S&P 500 goes absolutely positively nowhere, and we're in a secular bear market, and we really don't see a lot of progress but a battle back and forth between stocks and bonds inside of this upper orange box. Thus, if we were near the end in the present day, meaning the kind of last hurrah look, we would expect this ratio to make a turn like this. This is after the peak, and then it turns up. The present day, we really don't look anything like that. In fact, we're at the same level here that we were in the year 2000, very indecisive here, and it looks like we're getting a break in the wrong direction for bonds. This is favoring stocks. In 1999-2000, the turn favored bonds. You can also make an argument that investor behavior here, this indecisive seismograph look, is a big fractal, and this is the small fractal here, an indecisive seismograph look. In both cases, we get a high, a higher high, and then a reversal in the other direction. A high, a higher high, and then a reversal in the other direction. In this case, that reversal lasted for a long period of time. This case, to be determined. This hesitation here is near the early stages of the secular bull in stocks to the right of 2013. This is where the S&P 500 exceeds the high from 2007-2008. Since we're leaving the larger box that was started when the secular bear started in the year 2000, we can make an argument that this secular bear is ending. So this is a secular bear for stocks in this case. It's very, very possible this breakdown here is telling us that this ratio is now joining the secular bull party that was started in the stock market in 2013. Having said all of that, this point here looks more like this point here, but realistically, it really doesn't even look like this point here. It's possible that this point here looks a lot more like something that occurred between 1982 and the year 2000. More on that later. Moving quickly, 176 trading day rate of change for international growth stocks. Something that just happened in 2020. Only two previous times we have data going back to 1991 on the rate of change. Both of those instances bullish. 2009 after the major low, and 2004 after the low in 2002, and a retest in the S&P 500 in the spring of 2003. We interrupt this regularly scheduled broadcast for a quick public service announcement. This is from the IRS website. It's about required minimum distributions for IRAs, affectionately known as RMDs. You can pause your video player. You can find this on the web as well, from Charles Schwab. Can you forgo taking RMDs in 2020? And it has a wonderful and detailed Q&A. Our next category is maximum complacency. We'll kick this segment off quickly with a monthly chart of the CBOE put-call ratio. This is for all options. This is a monthly chart, so it shows the level at month end. Calendar year 2003 on the left side of your screen, the present day on the right, the S&P 500 on the bottom for reference purposes. In oversimplified terms, higher we are, the more fearful investors are, the lower we are, the more confident or complacent they are. It was very, very easy to look at this chart going back to 2003 and say, for the most part, this thing's got nowhere to go but up. When we get down here, we go up. That may or may not be true, but this is true. The present day level is basically very, very similar to this low level here in late 2013, and it's very, very similar to these levels over here. So how concerning is this? Well, at this point here, and this point here, from a longer term perspective, the answer is not very concerning. And here we rallied for over a year before having a correction. This chart is dated month end because it's a monthly chart. It's in the history books as of November 30th. So let's stick with the same indicator. This is a monthly chart. Now let's look at the same indicator on a daily chart. And in both cases, the line here shows you the 10-day simple moving average of the put-call ratio. Remember, fear is high. This is the financial crisis. This is after the flash crash. There's a waterfall decline that happens here in 2015. This is the max fear here heading into Christmas Eve in 2018. And this is your COVID fear spike that happened in Q1 of this year. So all things being equal, fearful, confident, or you could say complacent. Once again, the present day level only seen here in January of 2014 when we're looking back to the start of the bull market after the low in 2009. So let's examine this period a little bit more and see what we can learn. This is the put-call ratio here. This is the S&P 500 here. What happened in the S&P 500 when we had this similar look here to the present day? The answer is it dropped 5.76% relatively quickly, and then it gained 22.05%. If you want to see that on a chart, here's January of 2014 here. Here's the same put-call ratio here. This is the S&P 500. Right off the bat, the complacency, quote unquote, did catch up with the market. You can see the S&P 500 here dropped 5.76%. That's the bad news. The good news is it took 19 days to fall 5.76%, and then it only took 11 calendar days to earn back 5.55%. You can see here it was a V plunge. And from this low here, so after the 5.76% plunge, the S&P 500 rallied an additional 22.05% into the spring of 2015. That's the January 2014 case. Let's move to the left side. I'm going to examine this case. You might not have noticed this off the bat, but you can make an argument down here is very, very similar to the present day. How can you say that? Very, very fearful up here. Very, very fearful up here in the financial crisis Q4 2008. Then we drop rapidly down to the lower end of the box. We drop rapidly down to the lower end of the box. I think you can make an argument that this is the first low. This is a higher low. This is the first low. This is a higher low. Thus, this point here in the present day, similar to October 16, 2009. Here's this period here blown up. First low, second low in October of 2009, after the S&P 500 has moved a long, long way. Hence, very similar to what we have in the rearview mirror in the present day. So what happened walking forward from the date of the similar signal on October 16, 2009? Something for the bulls and bears here. Once again, almost right out of the gate, the S&P 500 dropped or gave back 4.73%. Took 14 days for it to fall, but once again, it was like a V move. We lost it and we almost gained it right back. So what happened? We dropped roughly 5%, then we rallied, had another give back almost back to the same level. So we don't really go anywhere for several months. And then from this low here, we rallied 17.48%. Dropped roughly 5, rallied roughly 18. Previous case, dropped roughly 5, then rallied 22. Thus, we can make an argument this rally here and this give back, this is the S&P 500, this rally here, 17.48%, in this case, that was followed by a big plunge, the flash crash here. So at this stage of the bull market, we did go into a Nordique phase. You are here. You are here. We rally and eventually give almost all of it back, if not more so. The day of the signal, the S&P 500 was trading at 1087. After this point here, we get the flash crash. We drop all the way down to 1022. That type of action is similar to this type of action. Somewhat of a Nordique look. You get a bullish signal, but 2 years later, you're lower, helping us keep realistic expectations. The good news, from the date of the signal that's similar to the present day, It took 175 calendar days before we hit this stage of the Nordique phase. So what it's basically saying is, if you try to guess in the present day, and you say, well, I know we're in the Nordique phase. First of all, we never know anything in the markets. It's all probabilities. Are you going to sit in 100% cash in this case for 175 days, miss a 17% move off of that low, and hope you're right? It's one possibility. It's not the way we would approach it. So the Nordique phase here tells us if the market is able to rally between, let's say, 15 and 20%, we have to be aware that all rallies are typically followed by some type of painful give-back phase. Sometimes the Nordique phase goes back to roughly the same spot. Sometimes it undercuts it a little bit, and sometimes it rallies and gives back some of it. Now remember, all of this was tied to this similar look here on the 10-day moving average for the CBOE put-call ratio. So once again, in the present day, looking backwards, it's very, very easy to say we're basically at max complacency. Something bad has to happen. And up here, this is maximum fear. So if we're up here, we're eventually going down here. And if we're down here or down here, we know that we're eventually going up here. That may be a form of recency bias, because if we take this chart and go back a little further, here at the end of 1994, we could have said, hey, we're down at max complacency. We're nowhere near maximum fear. This is a contrary indicator. When everybody's complacent, it means they're fully invested. Really bad things are probably going to happen here. Is that what happened? Did we move from here back to the top of the box? Did we move from here back to the top of the box? Absolutely, positively, no. We don't want to get hung up in recency bias on any indicator. Remember, we were in a secular bear for the most part from this area here in the year 2000 until 2013. This period over here is during a secular run. So this is what we think maximum complacency is when we look backwards in the present day. But this is what secular complacency looks like. This is between 1995 and 2000. And between 1995 and 2000, really, really good things happened in the S&P 500. Remember earlier, we said we have a low and then a higher low. You can make an argument that we have a low and then a higher low here. And this low here happens in 1994, and this higher low here happens early in 1995. In the present day, we're about 8.35% in the S&P 500 above the February high. A similar point, this is the sideways consolidation in the S&P 500, would have been May 8th of 1995. So this is similar, this is similar, and the chart pattern in the market is similar. Consolidation, a breakout, now you're extended 8.35% from the prior high. In the present day, this would be February of 2020. This would hypothetically be November of 2020. So with this maximum complacency look and this maximum complacency look here, what happened next? Did we get that big give back? Or phrased another way, after this, do we enter a Nordique phase? To answer that, let's walk forward from this point here, May 8th, 1995. So let's say this is point A. Put it on the chart here. Here's the breakout. Here's the breakout. The answer is no. We never looked back in this case. We tacked on an additional 29.5% in the S&P 500 until the next serious correction here in 1996. In this case, your Nordique phase looks like this. This is point A. This is point A. You rally 29.5%, and then your give back is really, really small. You never come back down to the bottom of the Nordique logo. And you might be saying, well, we eventually gave this back, right? No, we did not. We never looked back. And why is this example important? Because this example helps us keep an open mind about much better than expected outcomes, even with a look like this. We've already proven that the S&P 500 could easily drop 5%, or it could rally and then have a Nordique type situation where it gives all of it, some of it, or maybe all of it and then some back. We also have a situation here that tells us we better not bank on that scenario. In this case, here's point A. So you're at the bottom of the Nordique logo. You know what the gain was from the bottom of the logo to the secular peak? Bottom of the logo to the secular peak, the answer is 192%. So in this case, there really is no Nordique phase. This is the secular bull look with the secular complacency. So what's the moral of the story? Number one, we've proven we can get that quick 5% pullback. We have 2 examples of that we covered. We know we could be entering some type of Nordique phase, and this example here in 1995 tells us it's also possible we get the secular complacency and the secular never look back situation, simply helping us keep an open mind about a wide range of outcomes. Then how do we handle it? Pretty much the same way we handle everything. No predictions, no assumptions, no forecasting. We trade the chart in front of us. If the chart in front of us is healthy, we stick with it. If the chart in front of us starts to deteriorate in a meaningful way, based on how much deterioration we see, we will adjust accordingly. So this example here tells us we really can't assume that we're near the end or that we're even near the beginning of the end. So let's expand a little further on Mr. Churchill's words. Now, this is not the end. It is not even the beginning of the end, but it is perhaps the end of the beginning. Do we have any data to back up that theory? You may be watching at home and you say, Chris, you're using the CBOE put-call ratio. You really should be looking at the equity-only put-call ratio. That's a fair assessment, and we believe both are important, and we do monitor both, and the model tracks both. Same concepts here. This is fear. This is quote-unquote maximum complacency. And you can see in the present day, we are near maximum complacency. Remember, this is the equity only. And here, with the full put-call ratio, we showed what secular complacency looks like when you drop out of the box. In the box is kind of what the secular bear looks like, secular bear for stocks. Thus, if the secular bull thesis carries any weight, we would expect to see a breakdown here, because you just told us that a secular bull market started in the S&P 500 in 2013, so what gives? Well, let's answer that question. During the secular bear market in stocks from 2000 to 2013 here, notice how high the ratio gets in the box. This is somewhat waning fear and hedging momentum. The further we get away from 2013, the more white space we have at the top of the box. This over here looks quite a bit different than the secular bear period in here. But we're still in the box. No, we're not in the box. This is what the chart looks like on December 2nd, 2020. You can make an argument that this is the shift. The equity put-call ratio is coming along for the secular bull ride by breaking down out of the box. Notice where the white space is here. It's just the opposite in the secular bear market for stocks. Down here. This is not a prediction. It's simply helping us understand one of many possible outcomes in both the stock and bond market. But these are the facts that we have in front of us as of December 2nd. Okay, bear with me here. This is equity only monthly. Now let's switch back to the standard put call. Covers everything. And let's look at a monthly chart going back to 1989. Keep in mind, the equity only has already dropped out of the box. We really don't have that here. We're starting to test the lower portion of the box. This is the breakdown here. This is the secular complacency. ADX telling you that this trend is rolling over, could be ending, getting long in the tooth. This look here, 1995, 1996, you can make an argument, ADX black above green and red. This is an extended trend. You can make an argument this one's even more extended. Therefore, we should keep an open mind about the standard put-call ratio, possibly joining the secular bull party by dropping down out of the box and going into secular complacency. That is absolutely positively not a prediction in any shape, form, or fashion. It really hasn't happened yet. We're just testing the bottom of the box. We'll learn something either way. Clients and regular viewers know that we've been talking about the secular bull story for quite some time, and the fact that we rallied sharply off of the recent low in a V manner and recaptured the 200-week moving average and the 200-day moving average doesn't throw the secular bull thesis out the window. The facts that we have in front of us today, we're still on track with all of that, and we may talk about it more in the future. The market still has some work to do. Do we have anything else that tells us it's possible that the S&P 500 switched to a secular bull in early 2013? The answer is yes. This is research from LPL Research. Bar chart starts in the 1920s and goes to basically the present day. It shows us the number of new all-time highs in a calendar year. This is what a secular bull looks like. 1950s into the late 1960s. This is what a secular bull looks like. The trend is steady and it tends to be up. The primary trend is up and you get relatively brief counter trend moves. If you want to look at a chart, a wonderful example of what a secular bull market looks like, look at the S&P 500 from 1982 to March of 2000. And especially focus on the latter stages of that secular trend in that case. From 1995 to 2000, for the most part, we have an incredibly strong trend with relatively brief and relatively shallow, relative to the gains that you're getting, corrections and pullbacks. So the thesis has been that a new secular bull market started in 2013. We know this is a secular bull here. We know this is a secular bull here. So far, so good. This box looks a lot like this part of this box and this part of this box. And as far as this secular bull goes, we really don't have back-to-back-to-back years that really look like a secular trend at this point. If you want to know what a secular trend looks like, look at calendar year 2013. It's a nice, steady trend with relatively shallow pullbacks. The other example that we have in the present-day bull is calendar year 2017. It's not unusual in the early stages of a secular trend to get exactly what we have. Look at 1982 to post-1987 crash. This period looks very, very similar, including the recent plunge looks very, very similar to the 1987 crash. In both cases, we plunge and come back strong. So if we were to ask, does this data, this is hard data that we can see, measure, and put in a model, does it align with or contradict the bull market thesis? It absolutely positively aligns with it and in no way contradicts it. Therefore, based on the data that we have in hand today, if it looks like a secular bull and walks like a secular bull, it must be a secular bull. Well, we don't know that. But this study here sure looks like a secular bull. This is what we opened the video with. How about fund flows? What can we learn? I'll let you pause your video player here. Tweet Liz Ann Saunders Schwab. She's tweeting a chart by a third-party research firm right here. You can Google it, and you can also use this web address here. This is their research. What it tells us is investors sold nearly $74 billion in equity mutual funds and ETFs in the month of October, the most on record. This is the worst on record. Similar to this plunge in July of 2002, similar to this low in October of 2008, and similar to this plunge here, end of December 2018. Thus, October of 2020 is similar to those three periods. Thus, we wanted to know, how did the stock market perform walking forward from the end of each of these months that are similar to the end of October 2020? Does the performance align with the secular thesis? The answer is absolutely positively yes. Here's S&P 500 performance from month end in each case. Since our month end in 2020 was October, we've moved quite a ways from October so we can project forward. And once again, if you project these numbers from the close on October 31st, 2020, once again, we get somewhat of a backing for that Nordique phase. It says 1 year from now, we could be at 34.98 or 35.52. In these two cases, basically where we are today in the S&P 500. So it's telling us it's possible that we could rally and then give it all back and maybe even then some. But 2 years out, higher than where we are today. 3 years out, significantly higher than where we are today on the S&P 500. Same can be said for 4 and 5 years out. We haven't moved 32% or 43% or 72% since October 31st, 2020. Once again, something that just happened a few weeks ago aligns with many of the other studies that we've been covering in recent weeks, and aligns really with many of the studies that we've been covering since early April of this year in these videos. This is a common refrain in the markets. Oh, we really need a correction before we can move higher. That may or may not be the case. And we've already shown that the data that we have in hand tells us it wouldn't be shocking at all if the S&P 500 backtracked quickly 5% here. However, we should also keep in mind that we just had a correction. So yes, this is a big move off of this low here, but it's not like we're wildly extended from a base. We're really not that much higher than we were in September. We just had a 10.55% drop from peak to trough, quickly followed by a 9% drop roughly from peak to trough. So this big move is relevant, and these are relevant as well. Simply helping us keep an open mind about a wide range of outcomes. This is consolidation and right now a breakout. And we also have this in hand, and we have something similar in hand relative to 1994 consolidation in early 1995 to mid-1995. And in this case, we were not in a Nordique phase. To the contrary, we were in a never look back phase. Once again, how do you handle 1, 2, and 3? It's basically the exact same way that you handle this plunge before the election. You look at the weight of the evidence and you try to decide, how concerning does this look? If we start to fall again, we'll follow the same procedure, making no assumptions about what happens walking forward. If you've been in this business a long time, you've heard this expression a lot. The world will never be the same again. Well, that's always true because things are always changing. And the world may never be the same again. That remains to be seen. But it's also possible in the weeks and months or years ahead that this is what many businesses look like today. And this is what those same businesses may look like in the not too distant future. That, of course, is to be determined. But there's a lot of frustration of staying inside and a lot of pent-up demand in the United States and all over the world. Wouldn't be surprising to see a scene like this in many businesses in the weeks, months, and years ahead. So once again, we have things that just happen in the present day that help us keep realistic expectations about the short term. And in this case, the short term could even be 1 to 2 years. But we also have a ton of hard data in hand that aligns with the resumption of the secular bull thesis, telling us as long as the chart in front of us allows, we can maintain a longer-term focus and possibly even let our accounts swing a little bit more. If you let your account swing in here, the rewards were amazing. And as always, we all know, under our approach, and yours may vary, the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.